Growth momentum is fading, very much in line with our theme of as good as it gets, but we're not suggesting that recession is approaching. US recovery is already in its 9th year, but typically economic cycles don't die of old age. There are usually two things that would cause a recession. The first would be some sort of shock, such as oil prices going to $100, $150, or perhaps trade protectionism. Neither of those things seems like a serious risk at the moment, but of course we are keeping a close eye on the risk of US trade policy. The other possible cause of recession is policy tightening, but it's going to be 2 years before American interest rates reach neutral level, even on Fed plans, which are much more hawkish than the rest of the market. That means policy is going to be stimulative until then, just getting a little bit less positive. Other central banks, of course, are well behind the US. Now, fiscal adjustment is also another possible cause of recession, but that's largely over across developed markets. So we don't see a risk of recession from renewed austerity plans. So overall, the cycle is maturing. Growth momentum is slowing. Yes, it's as good as it gets, but we think the risk of renewed recession for the next year or two is really still quite low.
Another month, another range-bound outcome. In line with a theme that we've been emphasizing now for some time, markets were mostly well-behaved throughout the month of June without moving very much either higher or lower. The underlying economic situation compared to last month is still largely unchanged, and we remain of the view that we are witnessing something of a growth moderation that may have a dampening effect on asset price rises, but is not going to cause any great disruption either way. In the equity market, there have been a few wobbles here and there, most notably in the technology sector. Now, this is one where we had downgraded from overweight to neutral, and it has underperformed. This was no great surprise given that valuations had become quite challenging after the sector had certainly performed very well in the year up to the end of May. On the other hand, healthcare, as well as the financial sector globally, delivered some relative outperformance, and again, this was in line with our call. Without any major changes in the views on markets or any impending signs of catalysts acting on stocks in the short term, we choose this month to remain on hold with our equity weights across regions and across global sectors. In fixed income, and especially in the credit markets, both fundamentals and technical factors are still very supportive indeed. Flows into high-yield funds remain very strong year to date from January onwards, and overall investor demand for new issuance remains strong. This is a point we keep emphasizing. This is both the case with private as well as institutional investors. At the current pace of new issuance in both global high yield and emerging markets, we're set to break new records for the year in terms of volume of new issuance. That said, we remain cautious and we say that it is important to exercise prudence and good judgment when adding new bonds to existing portfolios. There are still regions, and equally there are still sectors that offer good value and safety. Even if outright yields are more modest than they have been before, overall performance has been good. We are of the view that potential for capital gains in this sector for the rest of the year remains modest at best, but that the coupon earned is still worthwhile.